What's going on, guys? I want to talk about a bad trade that I'm in and how I'm going to manage it. I don't want to just post good trades on this channel and make it seem like I never lose because everyone loses, I lose, and I want to go through some bad trades because this is really important to see what you can do in a bad trade situation if you get into a situation where you don't like to trade. There's a few things I can do with this. Now, I got in puts last week. I got in, you can see right here, I got in these 385s. I had one of these. I already did the trade earlier. I'm going to show you what I did. But just for context, I got in one of these at 450. All right, these are 220. So I'd be down 100, I'd be down $230. I had three of these 380s at 350. These are down about 200 each, but 210. So altogether, that's about 800 or so loss. So I was down about $800. Now, I'm still biased short. I still think that the SPY is going to come down. That was my bias. Ultimately, we are better off shorting up here at this 404 at the 200-day moving average. And if we do get back up here, I'm going to go in short right there. I had a bad entry. I already went through all that. I got in on this day. I was looking forward to kind of roll over and come down and test the slope, but we didn't. And we're going sideways because it's Thanksgiving. I probably should have sold calls or puts. I've been past what I could have done. I don't want to get wrapped up in, you had a bad entry. You're so far out the money. I already know all that. They weren't that far out of the money when I got in the trade. Now they're far out the money. I don't want to get into what I could have done. And this point is, how are we going to manage this trade? I'm going to show you what I did. In this bad trade, I have 4 things that I can essentially do. Number 1, I can let it ride. I can let it ride and hold and hope that it's going to come back down and they're going to come back to at least break even and I'm going to get back my loss. That is bad because you're holding and hoping. Number 2, I can average in. This is bad because it's a bad trade. You want to average into good trades. Now, in certain cases, you can average in. Because I don't have that much time, I have 17 days till expiration. I don't want to just throw more money at this, especially in a week where we're going sideways because they're just going to burn up premium. So in this particular case, I really don't want to average in and throw money at it. Number 3, I can take the loss, right? And it's going to be about an $800 loss as it stands right now and find a better trade. Number 4, we can maneuver it by selling credit and rolling. Now what I did, all collectively, I had about $650, I think $700 in equity this morning left in these puts. So I had 3 380s and 1 385. I had about $650, $700. So I came out here to the 30th of December, 38 days away, and I bought 1 388. So now I'm closer to the money. I have way more time. So if the market does come down, we have Fed minutes coming up. We have an FOMC on December 14th and a CPI report. The CPI was super bullish. I believe it was this day. We had the biggest rally. If the CPI comes in hotter, we're going to sell off. If the Fed changes anything, and we have minutes tomorrow. So there's some catalysts that can bring us down, and we can always come up here, and then I can go short. So there's a lot of things can happen. Because 1-2% down day, if we do come down here, test this 21 moving average, these puts are going to go way up here. And if I can get 300, 400, 500 out of this one option, and my loss goes from minus 800 to minus 300, I'm okay with that. I'll take that loss down there and I'll salvage the trade. And then what I also did is I turned it into a diagonal. So I talk about we're going sideways. So I came in here and I came into December 5th, which is a closer expiration. I sold this 383 put for 120. All right, so I'm only up like $4 on it. So the idea behind this and how diagonal works is I sold the further out the money, sooner expiration put. So if the SPY closes by December 5th, or even if it doesn't get down here in the next couple days by Monday or Tuesday, this premium is going to decay. So I'm going to collect premium on this as this goes down. In my 388 put, even if the market goes up, this will lose value, but it's not going to lose as much as these other puts were going to lose because these expire way sooner and they were a little further out the money. So they're going to lose their value a lot quicker, just like this 383 put. So just to recap, I bought a 388 call for the 30th of December, and then I sold a 383 call, $5 out the money against it. If, for example, this closed in the money and they exercised it, this 383, I would simply exercise my 388 put, and then I'm $5 away, so I would make that 500. So I'd still come out positive a little bit in this trade. My $800 loss wouldn't go all the way away, but I could probably salvage about half of it. I'm okay with that. The point of it is I'm selling premium. As this decays, I'm going to gain money on this, and then I have way more time for the market to sell off. Now, even on December 5th, because I have the 388, if we come down to 385 next week and we close at 385, this will expire out of the money, and these will be worthless. I can collect all the premium, or I can collect maybe 90, $100 out of it. And then my 388 put is going to be $3 in the money. So I'll collect premium on that, on this one, and then this one will be in the money, and this one will be up more. And then I can do the same thing. I can roll this put, so I can, let's say this one drops down to like 15. I can buy it back, make $100, and then I can come out here to like the December 16th or the December 23rd, and I can do the same thing. I can maybe collect another $100 or so and sell premium on that, and I can collect this premium all the way up until my expiration. So I'm just selling puts against the put that I bought, trying to get back some of that loss. And like I said, the most ideal situation would be if we were to drop towards 383 but not get to it. These expire worthless. I collect all the premium, and then these 388s will be up because we'll be $3 in the money. So these will at least be up like $300-$400, so I can get some of that loss back. That's how I'm going to manage this trade. I can always roll it out to January. I can always average in, but it's always better to have more time with options. So this is what I'm doing. This is like a creative way that you can use to kind of hedge your bets. And I can still come in here and maybe sell a put spread or sell a call spread to finance some of this trade. And the point of this video is you don't always have to just take a loss, especially with options. There's ways that you can either salvage the trade or salvage the loss. Now, if we ultimately continue churning up, these are going to lose premium, but at least I'm selling premium on this first one, and I can keep selling premium. So I'm going to keep my loss condensed and allow that big move. If I do think we're going to sell off, which I am a little biased short, I do think that we're going to potentially roll over, and I'm waiting for this. And if we do get up here, I'm definitely going to get short up here. If these trades go bad, I can get January puts up here and go for that trade. But I don't have to just take the loss because I just managed to trade a little bad. I probably could have cut out earlier, but my indicators and my bias was that we were going to go short. Now we're in a kind of sideways premium burn week, so I'm going to take advantage, sell that premium against it, and try and get some of that loss back. Minus 800 to minus like 250, minus 300, I'm okay with that. And the most ideal would be is if we sell off towards 383, but we don't expire below 383. I'll collect all this premium and I'll be up on these 380 on these 388 puts that I bought. That's going to be the most ideal situation. So I'm going to let this one play out. This expires December 5th, so hopefully probably by Friday these are going to be down a lot. Even if this comes down to 390, these are going to be less and less value as time goes on because they're going to be losing their extrinsic value. So if you're new to options and this still doesn't make sense to you, we have our full-time trader course, link in the description below. You can come join. We teach you how to trade options. We teach you how to do all this stuff. Part of trading is you're going to have good trades, and part of trading is you're going to have bad trades. And the whole point of having bad trades is learning how to manage them. And when you first start out, most of the time you're going to take the loss, but as you get more advanced with it, there's creative things that you can do to hedge your downside. And you can go in and you can trade the VIX, and you can get VIX calls or VIX puts, sell credit spreads in the VIX, sell spreads within the SPY, iron condors, put spread and a call spread. You can do these things, collect premium, and as these options lose value, you gain money and you can kind of chip away at some of your loss. And the most ideal situation with a diagonal would be and what I should have done is when I got in those puts, I should have sold sooner expiration puts against them because I would have been collecting premium up until then. So I will keep you updated on what happens with this trade in future videos so you can see it. But that's what's going on right now. This is how I'm managing this trade. If you have any questions, you can go ahead and hit the comments and I'll reply. This is an experiment that you can see. So I could have just took the loss, but I said this is a good chance to get a video and kind of show people what you can do in bad trades. So have a happy Thanksgiving. I'll keep you updated on this trade. I'll post the result and what happened and how I salvaged my loss. I'll see you guys in the next